Hi, I'm John Bautista. Thanks, Chad. Thanks, everyone, for coming. This is a great turnout. This is one of our Total Access series. Today's topic is managing hypergrowth. And we have a star-studded group of panelists today. I'll introduce each one of them. We'll probably spend about 45 minutes talking with the panelists, and then we'll open it up for Q&A afterwards. The mics are a little bit crazy. We might abandon the mics if we have too much feedback. To my left is George Zachary. George is a venture capitalist at Charles River. George, and previously at More Data Dow Ventures. George has been investing in companies now for close to 19 years. Invested in Twitter, was an investor in Yammer, which was sold to Microsoft. Has had operating, I'm going to abandon the mic. Has had operating experience at Sun Microsystems. And it's terrific to have George here today to give us his perspective on the challenges that many of the companies that he's invested in face when scaling as rapidly as his portfolio companies have scaled. Next to George is Roman Stanek. Roman is CEO and founder of GoodData. He has really helped transform the world of cloud computing. Cloud Data provides a cloud-based platform that enables more than 6,000 now global business to monetize their big data. Prior to Cloud Data, GoodData, he was founder and CEO of NetBeans, which was acquired by Sun Microsystems, and Stanek, which was acquired by Mercury Interactive, and later Hewlett-Packard. Next to George is Barry Eggers. Barry's a venture capitalist. I've had the pleasure of working with Barry over many years. He's worked closely with many of the companies that he's invested in now, AV Networks, MapR Technologies, Nimble Storage, Pertino, and others. Barry has also held operating roles and executive roles in business development and general management at Cisco. And while he was at Cisco, he established many of the company's largest distribution channels across our OEMs and service providers and VARs. He was also helped develop Cisco's M&A process and worked on a number of acquisitions and integrations within Cisco. And then to Barry's left is Dan Levin. Dan Levin is Chief Operating Officer of Box. Dan mentioned they just finished the Box conference a week or so ago, had thousands of participants, their biggest conference yet. He's spent 6 years, prior to Box, he was 6 years in a variety of roles at Intuit, and he's also helped found companies. He was in a number of venture-backed startups, including executive roles at Replay TV, which was acquired by Sonic Blue, Guest Connect, which was acquired by Fourth Network, and Books That Work, which was acquired by Sierra Online, where he was co-founder and president of that company. So thanks to you gentlemen for joining us today. Again, the topic is scaling hypergrowth, and I'd like to start with the question: how do we define hypergrowth for companies, and what are some of the companies that you guys are involved with that you would define as are experiencing hypergrowth? So what is hypergrowth? George, we'll start with you on that.
Hypergrowth, a lot of growth.
Growth that gets a lot of hype.
Well, it can be both. In my experience in the companies that have had lots of growth, hypergrowth, there's usually this, you can describe it as you are getting a ton of interest from potential customers and users that is growing faster than your ability to actually make sure they're happy. And that's always a sign of hypergrowth. Okay, go to microphone.
Yours might work better than mine.
Is that better? Well, that is better.
Okay.
Okay, keep the microphone low.
These are hypersensitive mics. I think it's yours. Yeah, mine's the problem.
You can switch on and off too.
Yeah.
So, in my experience, hypergrowth is a state, basically, when a startup, when their users or customer base is growing much faster than their ability to actually communicate with the customers. And you can describe it because you see all the employees running around like crazy thinking, oh my God, this is going to be great. And an hour later, they're running around thinking, oh my God, we're going to crash and die. And they can't respond to their customers. So you can describe it. You can describe it through metrics as well, but so you try to capture it in terms of a feeling of what's going on at the company as well.
I agree. I would add to it, you cannot communicate with your customers, but you cannot even communicate well with your employees because the stuff is changing so quickly. You cannot communicate with your board, with your investors. It's just that state of mind. And, and I actually don't believe that metrics can actually, describe it, because in hypergrowth, you very likely are measuring the wrong stuff. You're looking at the wrong metric that actually doesn't help you to understand your customers, your employees, and so on.
Yeah. Not to like have everyone respond to every question, but to me, a company is like a person. We're born and we grow up, and there's a natural rate at which you grow up. There's a natural rate at which a company can grow and expand and develop organizational capability. And sometimes the pull into the market causes you to exceed that natural rate of growth. And when that happens, either operationally or in terms of your team, then you start to feel stress. And we can fight about sort of how much stress you have to be under to be in a hyper-growth state, but basically what we're talking about is an organization that's in a lot of stress, either technically or operationally or organizationally, because they're being pulled by the market faster than they're capable of naturally growing and developing.
Yeah, okay, I'll answer the question too, I guess. Yeah, I think hypergrowth can mean anything really outside the norm. And it could mean some things that you don't necessarily think about. For instance, Cisco, people don't really think of them as a hypergrowth company, but back in the day, they went from 80 million to 6 billion in about 6 years. That's an average growth rate over 100% a year. At scale, that's hypergrowth to me. Very few companies ever achieve that. On the other hand, we're in a company called Snapchat. You have teenagers, you know what that is. When we did the investment, the seed investment, they were processing 10 million photos a month. Today they process 350 million photos a day. That's in 2 years. That's hypergrowth.
Yeah. So one of the commonalities among the definitions that were offered is the pull into the market and managing the customer demand. So the question I have is, how do you get in front of that in terms of the team and the technology to make sure that you're not put in a position where you're unable to respond to the demand from the marketplace? What are the key, in advising companies and being part of the management team of companies, how do you get in front of that and managing that scale of growth?
You just repeat over and over, I will not be Friendster. I will not be Friendster. I will not be Friendster. I don't know, I'll start with the people side. To me, managing growth is all about the team you put on the field, and it's all about the people that are leading that team. If you have the right team, if you have people who are experienced enough to manage at significantly larger scale than they're dealing with today, if they can sort of see around the corner and understand what tomorrow's challenges will be, then you're in pretty decent shape. And for a senior leader in an organization that's growing very quickly, what that requires is you to be sort of in a constant do loop of, do I have confidence in this person today? Do I have confidence that they'll be able to do their job 6 months from now? If the answer is yes, go on to the next one. And I'm just constantly evaluating our leadership team and its capabilities with that in mind.
So picking up on that theme, how do you build the team that's going to be most effective for this kind of growth rate? What are some techniques that you guys have experienced? George and Barry, you're on boards of hyper-growth companies. Roman and Dan, you're experiencing hyper-growth in your business. So what are some of the lessons you learned in terms of building a team rapidly and a team that works in a accelerated growth point of view?
I'll go first just because I have the most timely bit of information from my board meeting yesterday with a company called Pebble, where I'm one of the investors. It's the Pebble watch company. And talking to the CEO of the company's grown incredibly quickly. They'll do 20 to 25 million of net revenue to the company this year with good margins. So he looks like he's 26 and he looks like he hasn't slept in about a month. And the truth is he almost hasn't slept in a month. And what I do is I just spend time talking to the CEO, like, what are you spending your time on? Like, where are you getting buried? And the first sign is that the CEO/founder is micromanaging lots of little things and not paying attention to lots of big issues and feels like they can never get on top of their game. So then we try to drill down to like, what is taking up so much time? As a watch company, he's got supply chain issues. That's a critical part. He's got software development issues. So then we start talking about those pieces and start saying, maybe you need someone who could be a VP of supply chain to basically make the supply chain work much more effectively versus having some individual contributors and a director there, someone who has more experience who can basically look through a bunch of the problems. So that's talking to the CEO founder to understand where they're spending their time between 7 at night and 12 at night are usually a good places to find where things are breaking.
From my perspective, I understand this kind of position, like hire somebody who can be, effective in 6 months. But at the same time, I've seen companies where you hire somebody way too ahead, and that person is actually not effective at that point. So that person comes from from a big company, they expect too much of infrastructure and so on. So like anything at a hyper growth, it's actually difficult because you don't know what's too much and what's too little. Like if you grow too fast, you may collapse. If you grow too little, you can actually may miss the market and so on. So it's actually quite difficult to understand what is the right thing, and it's difficult to kind of describe it on a panel. But I do almost every quarter. I do some high-level search. I just hired a CFO 2 months ago. I hired my CMO 3 months ago. So it's almost at my level. I spend 50% of my time interviewing and hiring, but at the same time, it's difficult to me to tell, like, is that person going to work? I'm trying to be as diligent as possible, but if you don't know where you're going to be in 6 months, it's actually very difficult.
Yeah, and you can as you say, you can overhire. You can create over hierarchy within the organization too, yeah. And stymie development and creativity. Dan, thoughts on how much of your time, Barry, you're advising CEOs. What's your advice as to CEOs and founders? How much time they ought to be spending in recruiting, and Dan, how much time do you spend recruiting?
Should I spend about 120% of my time recruiting? The other 20% actually terminating, but it just seems like we spend all our time recruiting people. I mean, you're always recruiting. You're always looking for people that can fit a growth model. The key thing is not everyone is great for a growth model. Some people just don't fit it. Their personalities don't work in a growth model. You got to be comfortable, not knowing all the answers and moving fast, making decisions, delegating to the team, all that kind of stuff that allows scalability of a company. Some people aren't comfortable with that. So you find that certain personalities work, certain ones don't, and then it's a question of can they actually scale. But you're always looking for more people, and sometimes younger people, I think, are more adaptive to the growth model because they haven't been used to the non-growth model, and so they don't know any better.
Yeah, so Aaron and I cheat. We split up the world. As it happens, I hire and manage the executive team, and I spend half my time doing it. So, but Aaron and I cheat because we've got 2 people doing jobs that would normally consider to be one person's job. So you could say we spend 25% of our time doing it, but I spend half.
And describe your recruiting organization. Do you have a full-time recruiter of HR? What have you found to be the most effective team to assist you and Aaron in recruiting?
So you got 2 fundamentally different problems. One is you've got to hire a lot of people into individual contributor roles and middle management roles, and we've got an internal recruiting team of about 25 people to do that. And then you've got an executive recruiting problem, and we have an internal executive recruiting team led by the woman who used to run executive recruiting at Adobe, and before that was in a large firm. And she's got a team of 3, I think, and they do nothing but director and above, executive roles. But frankly, my most effective recruiting tool is breakfast. I drop my kid at 7 a.m. at the school bus, and I go to breakfast almost every morning because none of my colleagues show up to work till 10. And I have breakfast with somebody that I think might be interesting. And I literally probably do it 2 or 3 times a week, every week. And that's how we've found a disproportionate share of the executives that we've hired, because it's so hard to find senior people. And I'm always trying to hire 2 years ahead. So if I'm trying to hire you to run a team of 50 people, I want you to manage 200 people, because I always assume we double every year, and I want you to be able to be 2 years ahead when I hire you. It's so hard to find people who can operate 2 years ahead, but can also do the job that we need them to do today, and can operate in a very high growth, very high energy culture. And so we interview a huge number of people for every one that we hire.
I think we're going to coin a new term today, which is hyper-breakfasting. Let's talk about building the company in terms of financial resources. Because if you're recruiting a lot of people, you need to be sure you've got the capital behind the company to do so. And one of the challenges is timing also on financing a company and not over-financing a company. George, what are some of the important lessons that you've learned in terms of when companies should take capital in going into the hyper-growth stage? What kind of capital, venture capital, venture debt, and what are some of the metrics that you use to guide your founding teams around raising capital to fund the expansion of the business?
So it's very different based on who the founder is and the scalability of the product as opposed to how much team you need to support it. So in the case of Twitter, I was one of the early investors, small investors, but early investors. And in the first year, the team there really had no idea why people were using the product, or even if people were going to use the product. So the first initial round, because the company was a company called Odeo, which then became Twitter, the first initial round was $5 million. And that was enough basically to get rid of the SMS bills from taking it out of the company's, actually the founder's pocket, because he was actually financing the company. And that allowed to hire enough people. We went up to 10 people. And then we got to the point where we had about 3 million users, we had about 15 employees, and then we scaled from 3 to 30 million users. And then that 6-month time frame, the founders realized, well, there's no way we can keep the site up. We're having huge site stability problems. So the first thing we had to figure out was, what do we need to do to basically fix the site stability? I don't know how many people you remember, but 4 or 5 years ago, Twitter was down frequently. We had uptime of approximately 80%, which is not considered really good. And yeah, there was no 9s even close. And so we had to figure out what to fix there and how much money we needed. So we had an emergency solution. We need to raise money immediately to buy lots of extra servers while we figure out how to fix this. So that was one kind of problem. That was really figuring out what the budget was as a patch solution. But we were in a place where we could actually raise the capital because people saw it expanding pretty quickly. If we weren't expanding quickly and we're just burning the money, we wouldn't have been able to raise it. So that's an example of a company that didn't require a large team, but required the right team, but a lot of money for infrastructure to scale. I'll let the other panelists comment.
Yeah, so a couple things here. First of all, growth consumes cash. So the faster you grow, the more cash you're going to need. More growth is not always better. And that's, I think, the most important point that I can make today, is that just growing for growth's sake is not good. You got to have growth plus something else about your business that's attractive. Look at, for instance, what are your unit economics for customers? Do they work? In a case of Living Social, which we were in, they were growing faster than anything I've ever seen, but the unit economics weren't that great. Turned out, not a real great business over time. So, what are your, most of the time it's margins for companies. What do your margins look like? If you don't have great margins but you're growing fast, you're probably growing too fast. So, I think in terms of financing the company though, early on, you could probably get it financed A and B rounds through just fast growth. But, after that, people are going to start looking under the covers. What is accompanying the growth, and what do your metrics look like, and what do your businesses look like? And I think that's the key thing. Sometimes you can grow too fast and have poor metrics, and it's going to hurt you in terms of financing.
We were talking earlier, Groupon is another example of that. Of course, they went to the public markets in that next step to raise capital, but we're not focused on the unit economics, as you mentioned.
From my perspective, the enterprise market is actually, it's kind of probably the worst, because you have to build big teams, and to keep customers happy, you have to invest in technology. So you have kind of, you have to have 99.99 in your technology and spend all that money to keep your customers happy, and yet you have to build, enterprise teams and so on. So that's, sometimes I feel like being everybody wants to be an enterprise space today. Please, look at it carefully. But sometimes you don't have a choice. We are kind of a little special in the big data space because what we do is we host it. But if you want to be, 2 years ago, if you wanted to be in a Hadoop space and so on, you had to grow really fast. And it may not be even driven by customer demand, but it was just driven by how much money the other players are able to raise and spend. And so sometimes it's actually in the enterprise space not driven by the pull of the market, but it's driven by the fact that if you don't spend that money, if you don't grow, you will be number 4 and you have no chance.
Let's talk a little bit about culture as the company is growing. Roman, for example, you were quoted as saying that you have, within your team, it's an open environment. Your calendar is even open. Everyone in the company can see what's on your calendar. And it's a spirit of openness within the team, and that is a cultural aspect that most startups have. Everything is open, financials are open, calendars are open, but at some point that changes. And curious as to the point of view of the panelists is what is the culture of your organizations for both Box and GoodData, and then for the VCs, what culture do you think works best throughout the scaling of the organization to keep the team intact and keep the culture intact?
I think culture is just a set of rules that we all agree to around how we're going to treat each other and how we're going to do business. And for most organizations, the culture is either intentionally created or it's unintentionally created. And if you let your culture get out of your control, then you get whatever you get, and it may be good and it may not be. So we take an incredibly intentional approach to our culture. We know exactly what it is, we know what we want it to be, and we use a whole bunch of very intentional change management tools to try to keep it the way we want it to be. But I think the first decision you have to make is, do you care about your culture? And then if you do, how are you going to maintain it when your company is growing very rapidly? And particularly, for example, we have an explicit goal to fill 50% of our people management jobs from inside the company, because we know that filling a people management job from outside always puts our culture at risk. And we report out to the entire company every 6 months how we're doing against that metric. This last 6 months it was 55%, so we were happy. And because we've identified that as a key lever in driving our culture. And that's just one example of the kind of intentionality that we bring to it. But not everybody does, and many people are very successful without intentionally managing their culture because they use other levers to drive the business.
From my perspective, culture is also connected to sense of accountability, ownership. My example is when we started, we treated our engineers like engineers, and we asked them to produce code, and yet we were a service company. We wanted to have 99.9 SLAs, and it created a lot of tension between engineers and ops people and so on. So we really kind of struggled with that culture of, hey, am I accountable for it? Am I going to be successful? Do I throw code over the wall? And so on. And then we did a little change. We kind of redefined the role of engineer is not somebody who writes the code, but somebody who actually operates the code. And that completely changed the culture because people started to feel accountable, successful, they could point to their success, they changed the behavior, they changed the quality of the code. So little change, like literally like redefining like who owns the delivery changed completely the culture and engineering team. And it was a big lesson learned, and this was my first time I did a SaaS company, so I had no idea that this is how you should do it. And that's one of the problems with hypergrowth is that you usually find out like 6 months into it that you do something wrong. And as I said a couple of minutes ago, metrics usually don't help. You know, you measure stuff that you shouldn't be measuring. I always had this feeling that there's something going wrong, but I don't know what it is. I don't know what it is. I'm looking at the wrong metrics. I'm looking at stuff that is working, but there is some part of the company that is not going well, and I don't know about it, and I need to find out, and I need to find some analyst, some metric that actually will actually visualize it for me. And that's the problem about hypergrowth, because you don't know what you don't know.
Barry, how would you describe the culture at Snapchat and what is being done to maintain that culture?
By Facebook, I don't know. It's, I mean, they process 350 million photos a day. They got 17 people in the company. So the culture is they only hire people they think are a superstar, mostly kids, by the way. The average age is probably low 20s. And they feel like they're serving their customers, which are kids in their 20s or younger. But they feel like they can do anything and they're going to change the world, and that's great. I hope they can. But also I think they don't feel like there's any barriers at all into what they're doing. And that to me is tremendous. It's probably not that. It's probably harder to get when people get older because they realize there are barriers over time. But, I like the kids. I think that's why some of the best entrepreneurs we've seen in the last 5 years have been kids. I mean, how old was Aaron when he started Box? He was
19.
There you go.
And George, fast forwarding into Twitter, how would you describe the culture at Twitter today versus what it was when you first invested in the company?
It's radically different. We had 3 different CEOs. There was Jack originally, who was the CEO, while Evan was the chief product officer. But everyone knew that Evan was really rich and bought out the previous shareholders. So people only listened to him and not Jack. Jack then got transitioned out of being the CEO. And then Evan kind of established his own cultural overlay on top of that. And then Dick Costello got promoted from COO to CEO, and Evan basically left working at the company, which created a brand new culture. So we had basically 3 different groups of culture in the company, which has been actually very difficult the last 2 or 3 years to basically unite all these people. It led to a lot of people from the first 2 groups being exited out of the company. As Dick basically was a little bit Stalinist, I'll put it that way, in uniting the culture and getting rid of people who really weren't working as hard. A lot of people knew Twitter early on as a bunch of people who lived in Soma and really didn't work. And it's basically kind of true, because I would show up at the company at 2 o'clock in the afternoon. I'm not known for early rising, and there would be like no one there at the company, and the front door would be open, and you could just walk in and take everything. And that wasn't considered unusual, and now like it's quite the opposite. So, and the company was really leaky at the beginning with information, and now it's super tight. And but it took a lot of work on Dick Costello's part to basically get the whole culture to work, the whole company to work together and build a brand new culture.
What are, for the business leaders here, what are your techniques in terms of how to communicate to your team, communicate the vision of the company, and keep the people in your organization up to date on the vision and the metrics and the progress of the company, providing information about the company, what works and what doesn't work?
Metrics. I guess that's what I do. You said that, when you start, you want to be as transparent as possible. You want to, everybody should see every single metric, and everybody should see, all of the result in one place, and so that people actually feel accountable and ownership and so on. we are not at a point yet where we will start to hide it. I know that at some point we will have to say, look, this is not public information, and we will not be able to kind of, we will have to somehow become less transparent. But from my perspective, it's it's transparency, but it's also, what you spoke about a couple of minutes ago, when you grow so fast, you don't have time to communicate with your customers, but you also don't have enough time to communicate with your employees. And that's where the middle management is actually absolutely critical. I believe that for hypergrowth, it's not the C-level staff, it's the people in the middle who actually go every day and they understand the mission, they understand where the company is going, and yet they deal with all of the change and all of the things that break, and they don't panic, and they just go and fix it and solve it. And that's what makes the hypergrowth companies kind of successful. I can be on panel, and there is somebody in the company solving problem with a customer that's overloading our systems today, and that's what needs to work.
Dan, you're shaking your head.
No, I'm nodding.
Or you're agreeing. You're agreeing.
I think, as I said, I have a model for everything, and I think of companies as people. And people change as they get older, and so do companies. And the operating mechanisms you need to use to run a business change as that company grows and matures and goes from one office to many offices and 50 people to 500 people, et cetera. And one of the sets of tools that you have to manage and change over time is the way you communicate. And I would say, if you asked a boxer, what they would say is there have been times in our growth from 0 to 950 where we've been excellent at communication, and there have been times where we've been far less than excellent, and usually that's because we failed to make a timely transition from one set of tools to the next, from one set of operating mechanisms to the next, as the company went through its growth. Friday lunch is a very important tool for us. It's an all-hands meeting. It's every week. We bring customers in to speak. We review the top-level organizational objectives. We review critical company projects. We demo new technologies. One of the areas in which we've had a lot of challenge is dealing with Friday lunch as we've moved into a multi-office environment instead of a single office environment. We use a lot of email, and we rely, as Roman said, on our middle management to cascade a lot of information through the organization. We deploy that information at the executive staff level, and then we rely on the cascade to share it down through the organization. We're very transparent as GoodData is. We really share essentially everything with our entire company, and we hope to be able to continue to do that.
Jerry? Yeah, so a couple things. Well, I think when you're growing really, really fast, like both you guys are doing and companies we've seen, it tends to decrease productivity. It has a negative effect on productivity. So I think you have to stay really close to that and try to measure that as well as you can. The first thing I know that, I bet you guys do a great job of this, is how do you onboard new employees? You have training for them. Can they get up and running day one, or they sit around for 2 weeks trying to figure out, what they should be doing? That to me is critical. You got to have onboarding, got to have some kind of training. There's all sorts of ways to do it. The second thing is, do you measure your productivity? So what are the basics? I mean, sales productivity is pretty easy to measure. You got to keep track of that. Marketing productivity, do you measure all your programs where the marketing dollars are going and what they eventually turn into in terms of leads, qualified leads, and closed leads? And then third, engineering productivity. There are ways to measure engineering productivity, and you got to do it. So I think you got to stay close to those numbers and just manage them, not overly manage them, but know whether you're getting $1 here, transforms itself into $2 someplace else.
George, what are your thoughts on measuring productivity within the organizations? There are metrics that board members and management teams look at in terms of business metrics for customers, financial metrics. Are there metrics that you look at in particular with regard to productivity?
I tend not to look at things per employee other than what the total gross burn rate of the company is and whether we're making progress on first establishing product market fit. That's the number one thing before you scale. You should have product market fit, otherwise you're just going to blow your money. So you can usually see that the amount of employees that you've got are either getting the product market fit or not. And productivity there is actually very hard to measure because sometimes you meet an engineer or a director that can make a great product and radically change the productivity, and sometimes you don't. And a lot of times it's very difficult to know that until you actually have that person hired. There's a chemistry fit to driving productivity as well, I feel. after you establish product market fit, which is really kind of a continuous process, but you start to see signs of it, then you start looking more at productivity in the scaling phase, and it's, okay, on the sales side, how much revenue are we driving per salesperson, we're driving per SE, what's our overall profitability over the whole business? But I tend not, I don't really know how to measure productivity. The only thing I can really measure is the company achieving its goals, is it getting to what I like, which is a winner-take-all business. Which is, I'm in the business of wanting to fund things that are monopolies. I don't want to fund things that are just businesses. So I'm always looking for the metric that implies that this is going to be a winner-take-all business.
Let's talk about product market fit and maybe some examples for each of the panelists of examples of, George, you mentioned that companies are continuously fine-tuning that product market fit. So some examples of where that's worked, or companies that have pivoted and then been quite successful in terms of the product market fit.
Well, I would say the one that was very clear was I was the original investor in Yammer, and Yammer scaled very quickly on a per company basis, and we looked at all the metrics of engagement per user. And what we found was within companies, there'd be a small emerging base of users who would love it and lots of other people who wouldn't. So we had a good feeling that we had good product market fit, but there would be quarters where the engagement per employee would go down, and the engagement per user would go down, and then we'd start to worry, has the market moved? Have we not built the right product? And a lot of times, if you're trying to scale and you're out of product market fit, you're just going to be burning cash and diluting yourself, basically. But in this, specifically in the Yammer case, we just tried to have the best people focused on product, and are we building the right product? And that's a loop that basically runs between the founders, management team, and engineers that's like nonstop, continuous every day. And you can test it. You can test it quantitatively and qualitatively.
Roman, examples within GoodData.
In my case, first of all, I would like to go back to the metrics. In most cases, what I see is that people measure activities, not productivity. Like, you can measure activity of your developers, but how do you know what's productive, what's not? And that's actually, I do believe that that's one of the areas that people don't really know, is how to measure productivity of your development team. It's a big spend. In sales, you measure activity of salespeople. You can measure, in marketing, it's actually even more difficult, because then you have the notion of cohorts. You don't really know what worked until the whole cohort kind of matures and so on. So it's again, it's my business, and I know one or two things about metrics. But going back to the product market fit, the problem with product market fit is that you control, as a CEO, you control only half of the equation. You control the product, you don't control the market. And in today's world, market can change very rapidly, and that's why kind of understanding, engagement with your customers. In a data space, there's a data company going public every day, or not every day, but every quarter, every month. So I'm looking at always at the market, like, how do I adjust my strategy so that we kind of avoid the big landmines, and how do we grow, and how do we kind of, what our strategy is going forward, and that's kind of that needs to get communicated down to the middle level management and employees, and that's the biggest challenge of growing in fast changing market. Do you go every time you see a change? Do you go and communicate to everybody, or do you keep it kind of until you have a plan? Or that's kind of I don't think there's a right answer, but again, product market fit. It's a changing dimension, and you have to always be kind of on top of it.
Thanks. Dan, what are some of the challenges and the bump in the road that you guys have overcome in product market fit?
Well, I think the best example that I can think of is PayPal, who I think started off doing end-user to end-user payments, right? And ended up, that wasn't the business that was interesting. The business that was interesting was internet payments, and particularly auction payments. And I think the biggest mistake people make is they think if they're growing fast, they know why. And very frequently, you have no idea. People are using your product for something, that's for sure. They're hiring it to do a job. It just ain't the job you think it is. And listening to your customers and really deeply understanding what are they doing with your product is really important. And from my own background at Intuit, the lesson there is they surveyed all the Quicken customers, and it was, I think, like an MBA intern stuck a question on the survey that said, what are you using Quicken for? And 43% of people came back and said, we're using it to run a small business. So obviously that was a mistake. The data had to be wrong, so they ignored it. But nobody remembered to take the question out of the survey. And next year they ran the survey again, and it was 46%. And somebody said, that can't be right. This thing's a consumer checkbook balancing product. How can people be using it to run their small business? And that was the birth of QuickBooks, which is one of the fastest products in the history of technology, of software, to go from 0 to $100 million and to absolutely dominant market share.
It's a great story. Barry, do the Snapchat folks know why people are using their service? Do they want to know?
I just asked my daughter. She told me. Strange thing, actually. That's how we found the company. Is my daughter came home one day and told me about the app at high school, and all the kids were using it, and they were using Instagram too. We knew Instagram, we didn't know Snapchat. This is in early 2012. And so I told my internet guys, and we found the company somehow. The guy was still in college. And so I actually listened. My daughter turned out to be a customer, and so I was listening to customers. Which is what you're just saying, to stay close to the customer.
It's a win-win. Great. I think we'll open it up for questions now. These have been very insightful comments, learning how to respond to companies that are going through hypergrowth, how to build a team, challenges there, how to communicate within the organization, the middle management, the effectiveness of middle management to maintain the culture and communication, and really truly understanding why customers are using the product in order to continue to innovate and grow the business. So I'll walk around and we'll have about 15-20 minutes of questions, and then wrap it up for some additional networking afterwards.
How do your incentive plans, excuse me, how do your incentive plans change over time so that you've got different organizations working together as opposed to on their own individual goals?
I'll just take a high-level view of it. And from my experience at Cisco and from companies that I've seen, the most important incentive plan is stock options, and that everyone's rowing in the same direction towards making the stock worth as much as possible. And if you don't have that, everything else breaks down.
Yeah, I mean, there are a lot of adages that people throw around, and it turns out, shockingly, a lot of them are right. And one of them is, well, people do what you pay them to do. You can be guaranteed that people will do what you pay them to do. So if you design a compensation plan that encourages everybody to solve for themselves, they will. And if you design a compensation plan that's aligned around one team, one number, we're all in this together, we all win or lose together, then they'll play as a team. So for example, just one real example at Box, every executive is on the same comp plan. And that comp plan is tied to one metric. It's the growth of the business, the amount of new annual recurring revenue we generate, minus the amount of churn that we suffer. And we have to hit a threshold for any of us to earn our bonus. And that threshold is tied to our board plan, and our comp committee agrees with that number. So it encourages everybody to think together about accomplishing the most important thing to drive the business forward.
Question here?
We had a question about early stage scaling. There seems to be this sound barrier of sorts when the founding team, they like to think of the company as their company. They like to stay in control, and deservedly so, they created it. But over time, you start to hire employees, you get investors. How do you manage that to where you end up actually looking more like a corporation with a lot of interests and a lot of invested interests there versus just founding team control?
I guess the short answer is some founding teams evolve. Your founding team is still there, I think, in large part at Box, and they've evolved to more professional managers, probably with help of people like yourself that have come in. Some founding teams don't evolve, and they have to eventually be replaced. It's painful for us to replace a board to replace the founding team. It's really painful because, as George said earlier, it changes the culture of the company. And when you change the culture, everything is thrown up for grabs. So you really want to maintain that, and if done right, you maintain the culture and you maintain the founders as important parts of the company, but as you do that, you surround them with more professional people that can help them scale and help the company become more of a corporation, as you call it.
How do you manage that in terms of if you discover that the founder can't be CEO, right? But what role is best for that founder when you're going to bring in a new CEO?
It could be a lot of things. It can be CTO if they're technical. It can be VP of engineering. In the case of Nimble Storage, the founding CEO became VP of engineering. We brought in a CEO, and it's been a wonderful transition. It's great. It can be just simply a marketing person or a product person. It really depends, but you like to have that person stick around if they're important and people respect them and they're part of the culture. Sometimes they don't want to do that though, and if they only want to be CEO, that's when you end up with that conflict that no one wants to see, but eventually has to get solved because it's holding back the company.
In my last company, I was actually in that position. I was a CEO founder, and for complicated reasons that had to do with the fact that I was not a US citizen, and we had more than 50% of the business with DoD, I wasn't able to be a CEO anymore. And I actually went to my board and I hired a new CEO. And I was looking at myself like, what do I do now? Yeah, I'm no longer a CEO, yet I'm a founder. I'm really deeply connected to this company, and I don't want people to be conflicted about it. So I actually moved to a different continent to run international, so that I'm not even in the office, so that CEO becomes a CEO with all the responsibilities. So I was there for my meetings, for my quarterly OKRs, and for the board meetings, and that was it.
And you remain on the board. In many of these cases, the founder is still on the board.
Yeah, I did remain on the board, yes.
Okay, good. I'll go back there in just a minute. Question here?
For a company that is expanding to new markets but also relies on outside sales, how do you maintain culture as you grow?
So remember I said I spent half my time recruiting? Well, last year, for 4 months, that half my time went into putting a new team in place in London. And a lot of that time was in hiring the right leader who we knew would be a good culture fit, and the rest of it was in picking boxers from our headquarters and moving them over to London and establishing the role they were going to play in ensuring the culture stayed the way we want it to be. It's incredibly hard. When you move from a single office to multiple offices, and of course it's even worse when that multiple office is not in the same geography. Like we have an office in San Francisco, that's a lot easier. I just work in San Francisco, Aaron goes up to San Francisco, Dylan goes up to San Francisco. But when you're talking London or Tokyo, you have to be super thoughtful, super intentional, and very, very careful about how you do it.
Yeah, absolutely. And Friday lunch in London is probably not Friday lunch. So not everybody shows up. I always believe that distance creates distrust. And if you don't do anything about it, it will actually always create distrust. It's actually unmanaged distance will always create people pointing, saying, well, these people are stupid because they are in distance. You don't meet them, you don't talk to them, and so on. So, first of all, understanding that that's the problem, and you have to work on it. And the second thing is, bringing people together. FaceTime, there is no, even in today's kind of Skype and whatever, technologies, there is no replacement for bringing people together in as frequently as possible. And it is a big challenge. It is, we have Thursday lunches, and I know that half of the company is not there. And I know that I communicate half of the company, and then I communicate with another half of the company at 6 a.m. in the morning, and I know it creates 2 different messages and potentially two different cultures. So it is something that you have to deal with a little bit, but acknowledge that it is a big problem, and it just happens.
What do good margins look like between a 2-person company and every time you add somebody in, or spend money as you're scaling, as you're growing? Obviously, there's kind of ups and downs, but what do good, consistent margins look like?
Well, I assume you mean gross margin on the product as opposed to net income, which doesn't really happen usually for most companies at the beginning. You know, I don't have a specific number, but usually you try to figure out what the unit economics are going to look like at scale. And then you try to, because the most important thing is not to establish good gross margin, it's basically to become the #1 company in the space. And sometimes you can do things that will make the margins look bad, but in exchange for basically increasing revenue much more quickly and blocking out your competitors. Really, it's whoever gets to own the cash flow in the whole industry the soonest that is usually the most interesting. So the gross margins can suffer. But you like to look at the gross margins along the way, and you know, if you're seeing at the beginning 10% gross margins and you're putting very little into other kinds of cost structure to support the product, and you're not being really aggressive, that's probably a problem. But like in the case of Yammer, we wanted to own the entire space, so we didn't care what the gross margin of the product was. We just said we have to grow as quickly as possible in each company, so we can own the social network in each company and do that as many companies as possible. So we didn't care about gross margin. All we cared about was revenue expansion and engaged users.
Back here.
Hi, communication. You know, when you have multiple offices and you need to communicate a change or bad news or something, and there is some, you know, all the time somebody that's on vacation, on PTO, out of the office. How do you deal with that, you know, thing? So maybe you communicate something important, and you know, 10 people are on vacation. Then, you know, how do you really manage that? Maybe you can explain.
I guess the first thing you can do is just not allow people to take vacation. That's a French company, it's a problem. Yes, people do go on vacation. Sometimes you can sort of signal, you know, if it's a really big announcement, you're bringing in a new CEO or a COO or something like that, you might signal ahead of time, hey, you know, tomorrow or the next day or something, we're going to have a really important announcement. If you're out of the office, try to dial in, here's a dial-in number, whatever. You know, you try to get as many people there. And people that aren't there, if they end up not being there, then you have to find a way to communicate with them. But these things travel fast. Word travels fast, the rumor mill travels fast. People know what's going on.
Question?
I think there's some Orrick employment lawyers in the room, you know, on the vacation one. I just had a question about the VC market changing, since there's 2 VCs on the panel. With VC funds kind of becoming much smaller than they were, how does that affect growth of companies and how you see that companies being built? You know, where not all the new fundraisings are $1 billion plus, they're actually going down in size.
Let me just add a corollary to that, which is...
Not a company VC fundraising.
Yeah, so I mean, it's sort of the phenomenon of angel investing, right? And when you're a startup, do you go to angels? Do you go to VCs? And there's a lot of large VC funds and funds that are built to fund the growth stage of companies. And then there's the angel network. What do you think is effective? How have your companies been financed, and at what stage do you think the venture capitalists should come in and invest and play a role in the company? Big question.
Yeah, first of all, I'm not sure that venture funds are getting smaller. There's just fewer of them. They're raising less capital is coming into the industry, which is great, and there's fewer funds. But you know, our fund's getting larger, and I'm sure Charles River's getting larger. But you know, there's certain optimum size you want to be, 500 million, sort of plus or minus. But you know, we also are early stage investors, as you guys are. We want to get in as early as possible. We don't view angels as a substitute for venture. Sometimes a company doesn't need that much capital, and an angel will come in and do a great thing with them, but we partner with them. I mean, angels need us like we need them. You know, companies, when they grow, need capital. I don't care what they are. To grow and to win a market, you need a lot of capital. Angels can't provide that. Small funds can't even provide that. So, you know, I'm sorry, I'm answering your question, but we want to get in as early as possible, and sometimes you do, sometimes you don't.
I think it's a good response that as Lightspeed, as Charles River has, $1 billion or close to $1 billion funds, they also have angel funds. And they're also doing angel investing and playing at the earliest stages of companies as well.
We do about, I'd say, 10 to 15 seeds a year. So that's a lot.
I mean, my sense is that the contraction in the industry is not having a huge effect structurally. You still got Tenaya and DFJ Growth and Meritech and these growth funds out there that can write a $25 million check, maybe even a $50 million check. They're not maybe doing it as often, and maybe some of the other funds aren't as large as they used to be, and certainly there aren't as many of them as there used to be. But I don't think it's not changing the structure of fundraising in larger rounds in any way that I've seen.
We have time for one or two more questions.
Just want to ask, in hypergrowth companies going from 100 employees to 900 employees in a very short period of time, how do you map and manage decisions that get made that don't then come back and bite you 2-3 years from now, because everyone's wearing different hats and sitting in different chairs, and how do you manage and record what's been decided?
I don't. There's no way you can point back and say, well, that was the decision somebody made. There's no way. There's literally people are accountable for what they do today, and there's no way to say, well, it was not my decision. Somebody else made that decision who was not here 6 months ago, a year ago. That would create complete chaos. I do believe that there is a point around 200, 250 people when you have to restructure the company to make decision differently. But there is no way you can say, well, that was taken by somebody who's no longer here. It's a company decision, and if you want to change it, you change it. But there is no pointing back.
Yeah, what he said. No, I mean, look, I think especially people in larger companies who come out of a larger company environment, they're used to a degree of stability and predictability that just does not exist in a rapidly growing young company. I mean, I came from an 8,000 person company, not a huge company, not Cisco. We did a 1-year plan, we did a 3-year plan, we had a strategy. Those things rarely changed in a significant way. We don't do a 3-year plan at Box. It would be insane. We can barely do a 1-year plan. We have a quarterly offsite, and we have not uncommonly significant changes in direction, in product strategy, in resource allocation on a quarterly basis. So, you have to communicate a lot. Of course, we use a very effective cloud-based content management system to track all of our documents and make them available to all of our employees, including all of our goals. Every employee's goal is visible to every other employee. But it's much more of a quick tacking sort of thing than a plant the flag 4 years out and sail there.
Or you use good dashboards.
We'll wrap up with a final question here.
So you talk a lot about growth, hypergrowth, and bringing people in, recruiting, and so on. At what point of the companies do you bring, or the growth, do you bring in a chief HR officer or a person who's responsible for managing that function?
I started that search. I always do every quarter high-level search. I started that search last week, and it's probably 6 months, 9 months too late. So I'm late on that one.
How many people do you know?
Almost 300. I'm late, and I don't think it's called VP of HR anymore. That's we live in San Francisco, so HR is for Cisco and Oracle. It's not VP of HR.
What do you call it?
VP of people or something.
Chief people officer. Really, it's talent acquisition. It's talent acquisition, and my view is you want to do it before you get to 100 people, because it's always later. It always is too late. Right?
Again, as I said, that's one of those decisions that I should have made, a year ago, and I didn't, and it's now biting me, and so.
What causes you to have that realization that you should have made that decision 6 months ago?
Because I see it. I see kind of, the need for that person today, and I know that a good search will take, 3 months, and I know that, and when you do this level of searches, you know, you have like in marketing, half of the time it doesn't work out. So I will have to, you know, what if it doesn't work out, I will have to recover. So it may be that I will not have a good person for another year. And that's the problem with, you know, that's one of the kind of my lessons learned from, you know, growing a company, that big decisions usually take 1 year to recover. You know, you hire a wrong VP of sales, it doesn't happen and you realize it in 6 months, or VP of whatever. It's just 1 year to recover, and that's why those decisions are so critical, and that's why I should have made that move a year ago.
At what point do you hire a VP of mindfulness?
Chief chat.
or chief chat.
Actually, it's a funny thing.
Yeah.
I know early on in Cisco, we had a company psychologist, and I think that's becoming more and more common these days, just someone that can, there's a lot of team building, sometimes people will bring in outside consultants for team building, and you know, sometimes employees need psychologists because they don't necessarily deal with the other employees as well. That's all stuff to consider here as you're growing real fast.
Yeah, the stresses of accelerated growth and keeping the team together, making sure you're recruiting the right people and that they feel part of the team and the effort. I want to thank all our panelists for joining us today. It was a great turnout, great questions. It was a lot of fun.